Hi, I hope you're well. Thanks for joining me. Look, if you haven't subscribed to my channel already, it'd be great to have you on board. And I really hope you enjoy this video on Australian property market update for November 2021. So let's have a look at an overview of Australian dwelling values. So for the past month, we've had a 1.3% increase in values, and it's actually been the 14th consecutive month for positive value growth. Move down and we can look at the 3-month period, and we've also experienced a plus 4.4% growth rate across 3 months, and the rise in dwelling values in Australia reduced slightly, down from 4.8%, so backing off slightly. And then for Australia, the November update takes national housing values 22.2% higher over the past 12 months, adding approximately $126,700 to the median value of an Australian home. So if we look at the changes over the past 3 months, we can see, as we saw before with Australia, it's been an increase of 4.4% in dwelling values, which is slightly down at minus 0.4%. For the combined regionals, we actually had 5.9% increase in values, which is an increase of plus 0.8%. So combined regional areas are outperforming other areas of the country, and the average across Australia as well. So then the combined capitals, we have a 4% increase, which is down by 0.7%. So that's for changes over the past 3 months for those Australia, combined regionals and the combined capitals. If we push out to 12 months, we can see that the Australian dwelling values have increased by 22.2% across Australia. Across the combined regionals, it's actually been 25.2%. And then the combined capitals, 21.3%. So again, the regional areas are performing really well. If we look state by state now across the capital cities, we can see the data, if you like, for the last month, last quarter and last year. And we can see when we scan through the data that Brisbane and Hobart have performed really well. So Hobart over the past 12 months has actually had the greatest increase in property values, followed by Brisbane at 25.1%. And we can then see also too that Melbourne is down at the bottom at 0.6% growth over the past month, and then 16.3% for the past 12 months, as is Perth at 14.5% over the past 12 months. Sydney's performed pretty well as well, so you can see across the capital cities there, state by state, how they've performed over those last 3 periods. Looking at a couple of the property market indicators, we can see on the left-hand side median days on market. So this is the time that properties take to sell from the day they're listed to the day they actually sell. For capital cities, we can see that capital city homes, the median time on market is currently 25 days, and this is up compared to the low in May of 21 days. Then across to the right under auction clearance rates, again for capital cities, capital city weighted average trending lower, reducing from the low 80% range in early October to the low 70% range in late November. So a couple of the indicators there suggesting that the market is slowing down. Is this because of the time of the year coming into Christmas? We'll have to see what the new year holds for as far as getting a true indication of what those market indicators look like. Okay, so let's have a look at the gross rental yields for November 2021. So for Australia, currently sitting at 3.2%, combined regionals 4.2%, and then the combined capitals at 3.2%. So not strong at all, and that would be an indication of the fact that rental returns aren't keeping up with the increase in property values. So there's going to be a period of time when those rental yields are going to remain low until rents catch up with property values. And as an example, if we look at the 3.2% yield, gross yield for combined capitals, so we'd be looking at, well, if we use a $600,000 purchase as an example, at 3.2% yield, we'd be looking at a weekly rent return of $370. So $370 weekly rent for a $600,000 purchase. Gross rental yields for capital cities, we can see across those figures. So the figure at the top is the current gross rental yield, and then the one below in brackets is where it's moved from. So we can see that Darwin has the strongest gross rental yield of 6.1%, and then Sydney down at 2.4%. And if we look at those figures, the current figures against where they've moved from, we can see that these capital cities are starting to perform differently now, so from each other. So we can see that if, again, the yield is improving, that would suggest then that rents are starting to catch up a little bit with the purchase price. And if it's moving away, then again, it's likely that growth in value is actually moving away from the rental return. So yeah, interesting to see that markets are starting to perform differently. For gross rental yields of the regionals, we can see that they, for the most part, are a lot healthier. We can see we've got Northern Territory at 7.3%, WA at 6.1%, and South Australia at 5.7%. And then also we can see at the other end of that is Victoria at 3.6%. Again, on average, a lot healthier than for the capitals. So for finance and lending, fixed-term mortgage rates are rising, which could act as a disincentive for some buyers. Although fixed rates are rising, variable mortgage rates are less inclined to rise until the cash rate lifts. APRA has already lifted the serviceability buffer for new lending by 50 basis points, so that's an increase of 50 basis points above what the buffer was before. So the actual serviceability buffer is 3% higher than the standard variable rate. The cost of debt is likely to remain well below long-term averages, and history shows that an interest rate rise does not halt a boom. In the past, it has taken 5 or 6 interest rate rises to bring a raging market under control. Now, the RBA statement highlights, so the cash rate target was again held at 0.1%. The RBA reiterated its messaging that core inflation would need to sit sustainably between 2% and 3% before they would increase the cash rate, with expectations that inflation would hit 2.5% through 2023. The bank flagged the rise in house prices driven by credit demand from both owner-occupiers and investors, emphasised the importance of maintaining lending standards and the importance of appropriate loan serviceability buffers. So they're really going to look at responsible lending. And again, even though there's talk about interest rates rising next year, there's a fair bit going that would suggest that they won't rise until 2024. Alrighty, let's look at Property Market Australia summary. So it was said that the slowdown in the pace of growth is due to several reasons. Virtually every factor that has driven housing values higher has lost some potency over recent months. Based on median values, capital city houses are now 37.9% more expensive than capital city units, the largest difference on record. In dollar value terms, a capital city house is averaging approximately $240,500 more than a capital city unit. A rise in the number of homes available for sale is a key factor driving the slowdown in capital growth. Nationally, the number of new listings added to the market over the 4 weeks ending November 28th was tracking 15.7% above the 5-year average, the highest level since late 2015. Opening of international borders are also a net positive for housing market, although the most immediate impact for resumed overseas migration will be seen in rental demand, while an uplift in purchasing a home from permanent migrants is likely to be more gradual. Every capital city and rest of state region recorded a rise in dwelling rents over the month, with house rents generally continuing to record a faster rate of growth than units. The ratio of housing values to household incomes reached a new record high in June, as did the number of years it takes to save a deposit. A natural consequence of worsening affordability could see demand increase for more affordable, higher density housing options such as townhomes and units. The slowdown in housing market conditions is less obvious across the regional areas of Australia, where the monthly pace of capital gains has accelerated over the past 3 months. Demand for housing across regional markets, especially those within commuting distance of the major cities, is continuing to benefit from the rise in popularity of remote working arrangements, along with the renewed demand for coastal and lifestyle properties, and in many cases, more affordable housing options. The rise in listings and softening of key vendor metrics implies the housing market may be moving through peak selling conditions. However, it will be important to see if this trend towards higher listings continues in the new year. Well, what's going to happen with the market? Well, we'll have to wait to see next year, I think. And at the end of the day, it's really looks unlikely, highly unlikely, that we're going to get any major pullback in property values. The fact is that we don't have an oversupply of property. The lenders have been using a much higher serviceability buffer for some time, so it's unlikely that people are going to get into financial difficulty, which will mean they'll have to sell their properties off. We also can see that at the end of the day, the market determines the price they're willing to pay. So if you're not a motivated vendor, then there's basically not you. If the market's not willing to pay what you want, then you'll probably just hold on to the property. And equally, if you're looking to get into the market and prices haven't moved, then you may choose to stay out of the market. So there's not too much showing us that it's going to have a really big pullback. The other thing that we saw is that we're going to have the borders open, the international borders open, which means that we're going to have people coming into the country that at first of all are going to be looking for rental property, and then probably from there will transition to the ownership option. So there's a lot of things that are supporting our property market, and again there may be a softening which will allow potentially us as investors to have a little bit more of a say in prices and not have to deal with much with the emotion that's in the market at the current time. So next year will be really interesting to see what pans out. But look, again, I hope you found the information we covered in the video helpful, and I really look forward to seeing you next time. Thanks so much.